Good morning, ladies and gentlemen. As Steve indicated, I'm Bart DeLito, and I, like Steve, am delighted to be here. I always like to come to Atlanta. Atlanta, of course, is a very, very beautiful city and an important city. But one of the most important reasons why I like to come here is because the people are so nice. They've always been nice to me, and they've always been nice to VectorVest. And one of the nicest people in Atlanta is Lee Gregory. Lee, could you stand up for a second? Thank you, Lee. When we first released VectorVest in late 1996, Lee got a trial subscription, and he liked it so much that he called us up and asked a lot of questions. And he said, well, you know, it was so easy, he just started using it. He didn't read any instructions or anything. And he wanted his friends to see it. So he called us up and asked if we would be willing to come down and give a little seminar. And we said, sure. And Lee arranged the whole thing. And you know what? This is the very exact same hotel that we were in 15 years ago that Lee arranged the first seminar we were at. And so I'm doubly delighted to be here. Let me give you a little background. In speaking with some of the folks that are here before the seminar started, we have a number of people that are relatively new with VectorVest. How many people here have been using VectorVest less than 5 years? Less than, well, that's just about all of you. So I can pretty well repeat the same things I said 15 years ago then. Let me give you a little background on how VectorVest got started. I started investing in the late 50s, early 60s, and I did all the things I think a normal person would do. I read books, I attended presentations, and I joined a stock club and pretty much followed the guidance that was written in those books and literature and presentations. I was taught that the best strategy was to buy and hold, that you should dollar average on the way down, that you couldn't time the market. And of course, I went along for about 15 years and really hadn't made any money. Of course, I owned some stocks that made money for me, but I had others that lost money. And in 1974, the stock market was in a terrible bear market. Show you what my level of knowledge was, I didn't even realize that. All I knew is my portfolio wasn't doing well. And in December 1974, I became so discouraged, I sold every stock I had except the stock I was buying through the employee stock purchase plan. And I worked for B.F. Goodrich at that time. It turns out that I sold at the very bottom of that bear market. I sold in the middle of December. And about 2 weeks after I sold, I started to see these stocks take off like birds. And one of the stocks I sold was called Teledyne. I sold Teledyne for $10 a share and watched it go to $700. A guy by the name of Henry Singleton was the CEO, and he liked to buy the stock back. He kept pouring money and buying the stock, so the fewer and fewer the number of shares that remained, the higher the stock went. Well, anyway, I did not buy another stock for over 4 years. And as it turned out, in late January of 1978, I was living in Brecksville, Ohio, and a blizzard hit town. I heard that storm in the middle of the night. It sounded like a freight train was going through our backyard. And of course, I was too lazy to get up and see what was going on. I figured, well, if a train's going back there, I'll check in on it in the morning. Nevertheless, when I got up to go to work the next morning, I couldn't. Everything was frozen over, and it was slippery, and it was terrible. So I decided to stay home. And I happened to have a Forbes magazine. I still subscribed to Forbes at that time. And in those days, Forbes would have their annual edition of business and industry rankings. They would look at 500 companies and they would rank them. They would rank them on return on equity, on price performance, and I believe on sales growth. And I thought, well, you know what? I haven't got anything to do today, so I'll go through this magazine and I'll pick 10 stocks, and I'm going to hold those 10 stocks for a year and see how they do. Well, I started looking at their ranking and going from one to the next, and after about an hour, I realized I didn't have a clue as to what I was doing. Can I go to the next slide, Todd? I said to myself, what I really need to know is, what are these stocks really worth? How safe are they? And should I buy, sell, or hold them? I said, if I have the answer to those three questions, I think I could do much better in my stock selection process. So I put Forbes aside and I went to some old notes I had. I was intrigued by the idea of how do you value stocks. So I had collected a number of articles on the subject, and I looked at them and I got to work. By the end of the day, I had a formula and I began calculating the value of various stocks. And frankly, I was somewhat amazed because I was calculating the value of Coca-Cola and McDonald's and Philip Morris and stocks like that, and the answers seemed to be reasonable. So that got me going again. And after I began using these quantitative techniques, my stock selection ability became much, much better, and I became totally addicted to investing. And I have to admit, I am addicted to investing. I love the stock market. And a lot of people ask me, well, geez, if you've been so successful, why aren't you on a beach somewhere, reading a book? And I said, why should I be on a beach reading a book when I can have so much fun following the stock market and working with great people like I do at VectorVest and meeting folks like you? Life's exciting for me, and I'm very, very fortunate that I was able to get into the stock market and find it to be such a joy. Nevertheless, these are the things that I feel are vital to begin making the right decisions. Now, what we're going to do in this presentation, we're going to go and see how investors approach it in a classical manner, and then how we approach the analysis of a stock in the VectorVest system. Todd, if I can have the next slide. Classically, investors ask the question, if they're interested in a stock, be it McDonald's or Tractor Supply or whatever, the first thing they want to know is, what is the price? The price is very important. A lot of people won't buy a stock that's over $50 a share. A lot of people won't buy them unless they're under $20 a share. So price is important. Price tells you what it's going to cost to buy a share of stock, and that's about it. Doesn't tell you anything else. But you might assume that a stock that has a high price is much better than a stock that has a low price. That is generally true. In fact, Bill O'Neill, who created Investors Business Daily, is totally against buying stocks less than $12 a share. In fact, for a long time, he didn't even want to cover them. So price gives you an indication of the nature of a stock. But the next thing people do is they look at PE ratios. That's the price to earnings ratio. And what this slide says is that if you were to buy Tractor Supply, you would pay $18.50 for every dollar of earnings. And that's what you're getting. And people say, well, that may be a little high. I'd rather buy a stock that has a PE ratio of 12, because if you read most of the books, they tell you you're better off, it's a better value to buy low PE ratio stocks. But you find stocks have PE ratios all over the map. I haven't checked Netflix lately, but Netflix is trading at a PE ratio of something like 60. There's Salesforce.com That's a near 100 PE ratio. So every stock has its own PE ratio. And frankly, I never did like using PE ratios because, first of all, I don't know whether the P is high or the E is low. Here's one here, they don't even give you a PE ratio. The most damaging thing in my mind regarding PE ratios is that there is no standard of comparison. It's totally a subjective evaluation. Now, back in the early 60s, I joined an investment club. The investment club was patterned after the National Association of Investment Clubs, NAIC. Many of you may have belonged to one in your careers. What the NAIC did is they provided a little booklet that gave some guidance on how to pick stocks. And one of the things they said is you really want to look at the earnings growth rate. And they explained how to do it. And basically, it was a matter of getting semi-logarithmic paper and plotting the earnings per share as a function of time, and then drawing a line and trying to get a good estimate what that average earnings growth rate was. And they said that if the growth rate was higher than the PE ratio, the stock was fairly valued. So let's look at that, Todd. Here we have McDonald's. Incidentally, these growth rates came out of Investors Business Daily's internet database, and these are based on historical data. Okay? And McDonald's has a growth rate of 19 and PE's 16.5. You say, well, McDonald's fairly valued. Tractor Supply was maybe a little bit overvalued. Time Warner with a minus 6% per year PE ratio. What do we do with that? You'd never want to touch that. And of course, Time Warner has the lowest PE ratio, but it's got this negative historical growth rate. So what do I do with that? And then there's Northern Dynasty. Good old Northern Dynasty. You know, that's a gold mining company. And allegedly, they're supposed to have tremendous assets in the ground. Somehow or other, they manage not to make very much money, even though they've got all these assets, and gold's going up like crazy. So I don't know what the problem is there. Nevertheless, we have NAs. So the next thing we would do then is to calculate the growth to PE ratio. And Todd, could we take a look at that? Now, ladies and gentlemen, I want to inform you that the slides you have in your books are a little bit backwards. They have the PEG ratio for McDonald's and Tractor Supply, and they have the data for Time Warner in there correctly, but these are the correct numbers if you want to write those down. The growth to PE ratio for McDonald's is 1.15, and you would say, well, that's a fair value. Tractor Supply, you know, it's a little bit overpriced. Time Warner, well, I guess I wouldn't touch that. And Northern Dynasty is a speculation of any kind. So that was the extent of the analysis that we did. And even today, I listen to money managers on CNBC that are managing billions of dollars. And they like to use what's called a PEG ratio, PEG. That's the PE divided by growth, the reciprocal of what I like to do and what NAIC taught us to do. And I became intrigued with that ratio, and I began thinking, where does that come from? Where does it come from? Well, if you take a look at Wikipedia, they say it's just a rule of thumb. Just a rule of thumb. It helps you decide what the better deal is. And by this ratio, you would say McDonald's probably the best deal here. Now, how do we go from this situation to knowing what the value of a stock is? In order to do that, we've got to think about how the stock market works, what investors want. Investors want to make money. There's an old saying that says that money goes where money grows. So people invest in the stock market because they want their money to grow. However, it's not the only place in the world to invest. Some people feel the stock market is too risky, so I'll put my money in the bond market. And then there are a lot of investors that will invest in the stock market when they think it's undervalued, and they'll take the money out and put it in the bond market when they think it's overvalued. And how do they do this? And what they do is they compare what they spend and what they get in both the bond market and the stock market. Now, as of last Friday, the interest yield on AAA corporate bonds, long-term AAA corporate bonds, was 3.93%. In other words, if I invested $100 in AAA corporate bonds, at the end of the year, I'd have $3.93 put into my account. Anybody here got a savings account? Nobody's got a savings account. You poor devils. Boy, I'm sorry I haven't been here a long time because you need a lot of help. Seriously, though, if you have a savings account, you're getting barely nothing. That's not really an investment. It's sort of a safe place to keep some money. But right now, interest rates are at historically low levels. AAA corporate bond, 3.93%. And a lot of people say, well, that's not satisfactory. I need to make money, more money than that on my investments. And so they think about the stock market. The average PE ratio of all the stocks in the S&P 500 as of last Friday was 15.96 to 1, okay? In other words, for $1 of earnings, you're going to pay $15.96. If you spent $100 in the stock market, you would get $6.26 of earnings. 15 goes in 100 about 6 times, a little over 6 times. So what you're comparing, if I put my money in the bond market, I'm going to get $3.93. If I put my money in a stock market, $100, I'm going to get $6.26. So what are the trade-offs? The trade-offs are, if you put your money in the bond market, there's a lot less chance you're going to lose that money. If you put your money in the stock market, there's a lot greater chance it's going to grow faster than it would if you put it in a bond market. If you put in a bond market at 3.93%, that actually is the growth rate of that investment. If you took that $3.93 and you reinvested it in bonds, the same bonds, you're going to get another $3.93 times 1.0393. So that is the growth rate. The interest yield on a bond is actually the growth rate of your investment in that bond. If you put your money in the stock market, and you're going to be getting $6.26 for every $100 you invest, that's got a better chance of growth. So people invest in the stock market if they're greedy. They're looking for capital appreciation. They invest in the bond market if they're fearful. They're looking for capital preservation. So, ladies and gentlemen, that decision-making process is the essence of how the stock market works. People make those alternative investments, and therein lies the secret to calculating value. Let's look at the next slide. This formula looks a little scary, but let's see if we can make it a little friendlier. The V stands for value, okay? Now, if I took that 100 and I divided by the current interest yield of 3.93, that's what the bond market is doing as of last Friday, okay? Now, if I said E was $1 and I took it and put it and I divide both sides of this equation by E, I have V over E. Well, That's like the PE ratio, except I said I'll call it V since this is a theoretical equation. So I could have V divided by E, which is 15.9, equals 100 divided by IY. 100 divided by 3.93 is a little over 25. So I have 15.96 on the left side and 25 on the other. That's not an equality. How do we make an equality out of this? We look at the difference between the $6.26 of earnings that I would get if I invested $100 in stocks and the $3.93 that I would get if I bought the bond. And that difference is called a yield premium. And the yield premium has always been a measure of the fearfulness that investors have of buying stocks. In other words, they're saying, you know, why should I buy a stock? If I can buy a bond that's paying 4%, I'm not going to buy a stock unless it's giving me earnings of $6.26 for every $100 I spend. I need to get more earnings per dollar of investment than I do if I buy bonds. And the yield premium has always been an operative measure of the decision-making process that investors have. In our longer presentations, we would show graphically the relationship of PE ratios as a function of interest rates over a long period of time. And this yield premium could be as much as 2, 3, 4, 5 times the interest yield on a bond. Right now, it's only about 1.5 times that people are demanding. And if you look at history, you'll see that stock prices go up when interest rates go down, and stock prices go down when interest rates go up. And this equation is right in line with that. If earnings yield went down, since it's in a denominator, value would go up. If interest yields went up, value would go down. This yield premium, of course, is dictated by the reality of what people want to pay for stocks. We could say this, well, I got 100 divided by times $1, that would be 100 divided by 3.93 plus the yield premium, which would be 2.33. That gives me the 626. So the average value of the stock in the S&P 500 would be about $15.96 per dollar of earnings. The S&P 500 right now is making about $3.40, something like that. If you go into VectorVest and you look at the S&P 500 watch list, you'll see that the average value is about $54 a share. This is a very nice equation. I call it the quick ratio equation. Now, so this is the basis, and this is all built on what investors do, the decision-making process. Now, what we have here, we have taken this equation, and incidentally, if you want to see the derivation of that equation, I wrote an essay on September the 10th where I derived that equation because I said, you know, we got thousands of brand new investors. And I probably ought to address that issue one more time. So it's there, September the 10th, 2010. Okay? Now, all this, what is all this about? Well, I think we would all agree that PE ratios go up for stocks with higher growth rates. Anybody got a problem with that? Typically, that's what happens. So what this part of the formula is saying is that if growth rate goes up, the value would go up. And, of course, if interest rates go up, value would go down. And F stands for inflation. Down here, inflation rate. Now, we take the square root of this term, and we have R plus G divided by 2. That's what I call the good guys. R is the return on total capital plus the growth rate in earnings per share. I take that average value, divide it by 2, and divide by the interest yield plus the yield premium plus inflation. These are the bad guys. If these guys go up, value goes down. If these guys go up, value goes up. Now, why would one want to take the return on total capital and put that into a valuation equation? The reason why is profitability dictates the ultimate growth rate of that company. Consider, for example, if a company invests $100,000 and they made $20,000, at the end of the year they'd have another $20,000 to invest in the company and grow the company. If another company invested $100,000 and had a profitability of 0, they wouldn't have any new money to reinvest in the company to grow it. They'd have to go out and borrow money. And if they borrow money, they got to pay interest. And if they pay interest, they got a higher hurdle to meet. So I took profitability plus earnings growth rate, added them together, divided by 2, and got this formula. And we've been using that formula ever since 1978. And it is the basis of our valuation. So now, using this formula and the current data for the 4 stocks we had, let's take a look and see what the result is. When we use that formula, McDonald's is making over $5 a share, okay? And it has a nice growth rate and good profitability. We feel it's worth $93.57 compared to the price of $72. Tractor Supply, 55 versus $53.99. Time Warner, 48 versus 34.72. How did Time Warner get such a nice valuation if they got a negative growth rate? Well, the fact of the matter is, when we calculate growth rates in VectorVest, we look at forecasted earnings, and we look at recent history and forecasted earnings. And Time Warner actually has a pretty good growth rate on a forecasted basis. They have a very nice growth rate. I think it's around 20% per year. Historically, they had a terrible growth rate. But going forward, they have a very good growth prospects. And the stock market is a forward-looking mechanism. Northern Dynasty has a value of $1.49. So now you have a better basis of comparison. An investor at this point would say, okay, so I have this data. What is the likelihood that this company is going to outperform an investment in AAA corporate bonds over the next 3 years? And so what we do, go to the next slide, what we do is we calculate an indicator we call relative value. And this is an indicator of long-term price appreciation potential. What we do is we compare price and value, just like we were doing on that other slide. We look at the forecasted earnings growth rate. We look at the AAA corporate bond rate, and we look at risk. And we calculate risk, and I'm going to talk about that indicator in a minute. We calculate risk based on the consistency and predictability of financial performance. And the theory is that if a company has been consistent and predictable in their financial performance in the past, they have lower risk in the future. Okay? And then we do a calculation that is called a discounted cash flow analysis. And we take the answer and we put it into a framework of 0 to 2. Anything above 1 says that that stock has potential to outperform an investment in AAA corporate bonds. Anything below 1 said it would not perform, the potential not to outperform AAA corporate bonds. Let's look at the next slide, Todd. When we do this analysis, oh my goodness, Time Warner is right at the top with a 142. Now what that means is that Time Warner right now, based on their forecasted earnings, their forecasted growth rate, and their financial performance, has the upside potential of outperforming an investment in AAA corporate bonds by 42% over a 3-year period. AAA corporate bonds are paying about, 3.93%. compounded over a 3-year period, you're looking at a total gain over that period of time, 13–14%. This says that Time Warner would outperform that performance by 42%. McDonald's 35% and Tractor Supply. All three of those companies have a good outlook over the longer term. Northern Dynasty, on the other hand, has a very poor outlook, unless they start getting some of that gold out of the ground. So now we have our first indicator, VectorVest indicator, and relative value. Relative value, ladies and gentlemen, has so much more information in it that PE ratios do. A lot more information. So we have an idea now of what stocks are really worth. The next thing we want to look at is how safe are they. We have an indicator we call relative safety. And when I did this work originally was back in the late 70s, and I was still troubled by the recession and the bear market of the 73, 74. And so what I did is I went back and I looked at a lot of data and it said, you know what? If I were to make an investment today, I want to invest in a company whose earnings continued to go up, 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 right through that recession. And what I ended up doing is I ended up looking at companies like Coca-Cola and McDonald's and at tobacco companies, Philip Morris and some of those other guys. So I was looking at consistency and predictability. When I buy a stock and I look at the data, and if that company's been growing at 15% a year, I expect it to keep growing at 15% a year after I buy that stock. So consistency and predictability of financial performance is one of the key factors we look at. Of course, we also look at the balance sheet, the debt-equity ratio. We look at the volatility of price movement. We look at something like a dozen different factors. And we put all those factors on a scale, and we cast it into a framework of 0 to 2. Let's see the next slide, Todd. And so when we put all these factors together, we find that Tractor Supply, on a scale of 0 to 2, has a relative safety of 149, which is pretty good, very good as a matter of fact. If you go into VectorVest and you look at a long-term graph of Tractor Supply, and you put EPS, earnings per share, at the bottom of that graph, and you'll see just earnings per share, very nice performance level. McDonald's is quite good, not as good as it used to be because 4 or 5 years ago, they ran into a lot of financial problems with some acquisitions they made. Time Warner, a little above average, and Northern Dynasty below average. So there it is as far as safety goes. In an instant, you get a pretty good idea what's involved in a balance sheet and the safety of that company over a long period of time. The next thing we wanted to know is this stock going up or down in price? One of the things I learned when I started investing, I got a broker at Merrill Lynch, and he was a good guy. And he had a habit of calling me up and saying, Bart, you know, this great company had a drop in price today, and it's a pretty good deal. You know the old theory, if it was good at $50, it's got to be better at $40. And so I'd say, sure, let's buy a couple hundred shares. In those days, a couple hundred shares, nice piece of change. What I found is a lot of these stocks kept going down. And then one day, and here again, this is after I got it back into the market, one day I was waiting for a plane in Dallas, and I went into the bookstore and I saw a book called Follow the Leaders. And it's written by a guy by the name of Blackman. And Blackman said, what you want to do is you want to buy rising stocks in rising industry groups in rising markets. And he even advocated in that book that he wouldn't buy a stock unless it hit a 52-week high. I said, this guy's nuts. Then I began to think about it. And basically what he was saying is that if a stock was hitting a 52-week high, it had a great following. It had the big money, and the mutual fund managers, pension fund managers. it had the big money pushing it higher and higher. Do you think Apple got to be where it is because you and I were buying Apple? No. It's billions of dollars going into Apple from the heavy hitters, the big professional investors. And so he said, you want to follow those guys. So I thought about it, and I said, you know, this guy's right. If I buy a stock and I want it to go up, I might as well buy one that's already doing what I want it to do, which is totally different from what's his name? The guy says, "Mon back," on TV. Anybody know who that is? You ever heard Jim Cramer? Well, Cramer did that in 2008, and he got creamed. The problem with buying stocks that are going down in price is you don't know how far down is. Now, I can tell you this, one thing that we learned, if we're in a bull market, you can quite often take the risk of buying a stock that's going down because the low interest rates and the higher earnings will probably push it up. But you're not certain. If you buy a stock that is going up in price, you got a lot less risk. So I wanted to buy stocks that were going up. So we created an indicator called relative timing. And relative timing looks at the direction of price movement. Is it going up or is it going down? Look at the magnitude. How much is it going up? How much is it going down? And the dynamics. How fast is it going up? How fast is it going down? We tie those three things together in relative timing. And we cast that on a scale of 0 to 2. And incidentally, we look at several time frames. Now that we have real time, we calculate relative timing on a tick-by-tick basis. And so we go tick by tick, we go day by day, we go week by week, we go quarter by quarter, and we even go as long as a year in looking at time frames. Relative timing is a very fast, very smart indicator. And we'll see evidence of that as we go along. So on our scale, we have relative timing here. And Tractor Supply right now has the highest RT, which means it has the strongest uptrend. Time Warner was next, and McDonald's, oh my, look at that. McDonald right now, its price is in a slight downtrend. And the Northern Dynasty is getting hammered for some reason. I don't know. Gold keeps going up, but Northern Dynasty, it may have gotten a little too high for itself. Okay, so these are the three key indicators, RV, RS, and RT. As you can imagine, there's all kinds of combinations of RS, RV, and RT. And you would go dizzy if you tried to figure all those out. And so what we do is we calculate a master indicator. The master indicator is VST vector. It combines RV, RS, and RT into a single comprehensive indicator. And what we do is we use a vector formula. That's where the name of this service comes from. The vector formula says we take the square root of the sum of the squares. We take RV squared plus RS squared plus RT squared. We add them together. We divide by 12 to get it back on a scale of 0 to 2. And that gives us our VST vector. Now let's look at the next slide. If we rank these stocks by VST vector, we got Tractor Supply at the top with a 136. We have McDonald's, 121, Time Warner, and no surprise here, we have Northern Dynasty at 0.59. So right now, ranked by VST vector, putting all these together, Tractor Supply would probably be the pick. Incidentally, one of the things we do is we found that relative timing is by far the most important indicator. If you didn't know anything about a stock, you want to buy it while it's going up. The next thing I would suggest you do, you look at relative safety. And of the three indicators, relative value is the least important. So what we do is we put a coefficient of 0.9. We take 90% of this number, take 100% of this number, and we take 110% of that number when we calculate VST vector. Okay? So we want to get you into stocks that are going up in price. We want to get you into stocks that have the best relative safety, and we want to get you into stocks that have the highest RV. This kind of guy, I call a stock that has all three indicators below 1, I call that stock a 3-time loser. And the beauty of this system is that you can look at any stock, stocks that you never heard of. You look at RV, RS, and RT, you have a fingerprint of that stock. You have a fingerprint. Immediately, you have some knowledge about that stock. So, finally, are these stocks buy, holds, or sells? Let's take a look. The stop price is very important. It's an indicator of when to sell or cover a position. Our stop price is based on an adjusted 13-week moving average of closing prices to compute the stop prices. Now, let's look at the data. This is sorted by stop. 69.81 is the stop price for McDonald's. On 3/18, McDonald's closed at $72.99, so it's above the stop price. 53.99 is above the stop price for Tractor Supply. TWX is also above. Here, Northern Dynasty, 13.85 is below 14.66. So that's below the stop price, and it would automatically get a sell recommendation. And it doesn't make any difference. If McDonald's was below its stop price, it would get a sell recommendation. Now, these stop prices, you could use them as gospel or you could use them as guides. I suggest that you use them as guides. Our feeling is that if we're going to give you a buy recommendation on a stock, we're obligated to also tell you when to get out of it. So it's a guide. And Brian, tomorrow, is going to give a wonderful presentation on using stop prices of all kinds. Getting out of a stock is a very personal decision, okay? The last thing we want to look at is how do we put all this together to get our buy-sell recommendations. It's the bottom line. We consider all these factors. Let's take a look at the data. First of all, we talked about stop price, price, and stop price. To get a buy recommendation with VectorVest, we want the price to be above the stop. We want the VST to be greater than 1. We want RT to be greater than 1. That ensures the trend is up. VST being above 1 ensures that we got at least a viable combination of relative value, relative safety, and relative timing. And the price must be diverging away from the stop price. We want it pulling away from that stop price. We don't want it heading into the stop price. You could have a situation where the RT is above 1 and the price could be heading down towards that stop price. And when we see that happening, we'll give it a hold, okay? Price above stop, but any of the other three. Let's look at the data. Tractor Supply has a buy recommendation. Price is above the stop. The RT is above 1. The VST is above 1. And because it's got a buy recommendation, it must be pulling away from its stop price. McDonald has a hold, and so does Time Warner. McDonald, you see with the RT being 0.92, that wouldn't get a buy anyway because it doesn't have the RT above 1. Time Warner got a hold because apparently the price, this RT must be going down. It's only 1.1, and it's heading towards the stop price. And Northern Dynasty, as we said before, has the price below the stop. And that, in a nutshell, is the basis of the VectorVest system. I designed a system when I was running a billion-dollar company. I didn't have a lot of time to go through and look at graphs and charts and read this and do that. If I got information on a stock, I read in Forbes or someplace that such and such a company was doing great, I wanted to know instantly, practically, what is this stock all about? And with this database, I can get a very good feel for it. This, to me, is the heart and soul of the VectorVest system. Now, you're going to hear a whole lot of other stuff as we move forward. Thank you, ladies and gentlemen.